Welcome, everyone. We are so glad you can join us for JFL Total Wealth Management's on-demand webinar addressing the economic landscape as we move through Q4. With the presidential election next week and the COVID pandemic's extended impact on the U.S. economy, many investors are facing uncertain times. This webinar will address some of these financial and investing challenges you may be facing, as well as strategies you can consider through the remainder of 2020. Today's speaker is Jeanne Kane. She has an MBA from Duke University and is a certified financial planner. She has extensive experience with analyzing and managing our private clients' portfolios and with developing comprehensive financial plans. Welcome, Jeanne.
Thanks, Gretchen. So today's agenda is really pretty straightforward. First, I'm going to share a brief investor update, and then I'm going to discuss some ideas and strategies that you can consider. But before I get to the presentation, I want to take a minute to remind you that please stay healthy, because your health is our highest priority. We're still experiencing challenging and unprecedented times. And as we like to say, your first wealth is health. I always find it important to review that there are 5 key areas of financial planning. These are insurance planning, retirement planning, tax planning, estate planning, and investment planning. And even though today's presentation is primarily focused on the equity markets, as a comprehensive wealth management firm, we try to always consider the impact of any recommendation that we make, not just on one, but on all of these areas for our clients. So let's jump right in. So the first 3 quarters of 2020 were very confusing for investors. In mid-February, the S&P 500 hit an all-time high. And then because of the coronavirus, the S&P 500 fell from its 52-week high in February to a 52-week low in March. And although after March, the economy remained confusing at best, starting in late March, the equity markets, they rebounded to reach new highs by early September. And then in September, the stock market started to drift slightly slower, but as of mid to end of October, they remained slightly ahead at the beginning of the year. And although the stock markets had moved higher, investors still faced the following issues and factors in the third quarter. Interest rates and bond yields remained at ultra low levels. Now, those low interest rates and the desire for more space and the ability to work from home, that's helping push home sales to record highs. Unemployment improved. The national unemployment rate fell to 7.9% in September. However, that's still 12.6 million people who are out of work. And the unemployment rate combined with the end of the stimulus package in the second quarter, that's resulted in lower income levels in the third quarter. And the new federal stimulus package is being talked about, but it hasn't been fully negotiated yet. And then finally, disease experts are warning about the potential impact of the combined flu season with the progression of the COVID-19 outbreak this fall. Now, Federal Reserve officials confirmed in September they're going to be holding interest rates near zero. They also said they're going to keep them there for the next 3 years, which effectively means that the Fed's going to keep their key rates at or near zero until 2023. And with interest rates at these record lows, if you're an income-seeking investor looking for reasonable yields, you could be disappointed. The low interest rate environment has been described as a bonanza for borrowers and a challenge for income-oriented investors. So with interest rates projected to stay near zero for years, here are 4 ways low interest rates could impact you. For home mortgages and personal loans, if you have a fixed rate mortgage or a fixed rate loan, you have that interest rate that's locked in. So you're not really going to be affected by these changes or have these low rates unless you refinance. And homeowners with adjustable rate mortgages, you could have already seen your monthly payments decrease. This could be a good time for you to consider the benefits of switching from a variable rate into a fixed rate loan. And it's also a good time to see if your personal loans could be rewritten to these lower rates as well. Similar thing with credit card debt. Try and see, because this is a good time, rates are low, see if there's a way that you can reduce your credit card debt and reduce the rates that you have on that debt. For our savers out there and with savings accounts, since March, interest rates on even the highest yielding savings accounts have been less than 1%, and many times closer to zero. The days of relying on strong returns from money market accounts and certificates of deposit could for some time be a faded memory. Now, for our income-oriented investors, the idea that interest rates are going to be low for a long period of time, that requires you to think carefully about your personal investment strategies. This is an area where we can help you review your choices and hopefully meet your specific needs. So what's the potential cost for safer investments? So according to Barron's, the average bank money market rate on October 26th was 0.09%. And the average 12-month CD rate was 0.25%. For many investors, these low rates might not help you reach your goals. And if you're earning that 0.09%, it can take you 800 years for you to double your money. A CD at 0.25% could take 288 years. Therefore, you might want to consider stocks as part of your diversified portfolio. And although the stock market may have had some strong years since 2016, here's an interesting look at the market, and more specifically, the S&P 500. Now, the S&P 500 is an index of the 500 largest companies. So these are really going to be big, successful companies. Now, the rate of return for the S&P 500 for the past 5 years has been 75%. And on average, historical average, the market's going to go up 8 to 10% a year. So the past 5 years have definitely been above average. In September, Goldman Sachs noted that although there were strong returns in the S&P 500, 5 stocks known as the FAAMG stocks, is an abbreviation for Facebook, Amazon, Apple, Microsoft, and Google. Those 5 stocks had a return of 244%, while the other 495 companies in the S&P 500 had a combined return of only 41%. We can see that the overall performance of the S&P 500 has been pushed higher by how well these 5 companies did. If you're invested in a diversified portfolio, you may have FAAMG stocks in your funds. However, as a diversified portfolio, these funds would represent just a small portion, so their returns won't have an oversized impact on your performance. The net of what I'm saying is that you should expect your returns to be more reflective of the 495 non-FAAMG stocks than the FFAMG stocks. Let's shift gears here for a minute. There's a big election coming up in less than a week, and investors want to know, what's it going to mean for the economy? What's it going to mean for my portfolio if Biden wins, and what happens if Trump wins? Well, here we're looking at a chart that shows the S&P 500 and its performance during the last 9 presidential tenures. I love this slide because it really gets at the idea that it's really challenging to make a definitive conclusion. If you look for a pattern to see whether one party's in power, does a market do better than the other? There really isn't a pattern. And that's because there's so many different factors that impact and influence stock prices. Oil prices do, the economy does, what's going on around the world, what foreign leaders are doing. There are hundreds, if not thousands of other things that have an impact on the stock market. It's not to say that the US president doesn't have an impact on the stock market or the economy, but just that there are so many other factors that can have an impact as well. It's really hard to say if this party comes into power, then this is what's going to happen, or vice versa. I want to show you another chart as well. Here we're going to take a look at long-term growth of a dollar through various presidencies since 1926. Putting aside political views, and again, I think you need to do that as an investor. If we take a look at this chart and see that regardless of who's in power, I see the long-term growth of that dollar. A dollar invested in 1926 would be worth almost $10,000 today. And if I'm a long-term investor, then I want to stay invested during this period of time, even if it feels uncertain. So we've seen a lot of volatility so far this year. And I have a question for you. Is a future market decline, is that a time for you to get into the market and invest some new money, or is it time for you to get out? Well, I think this is a really interesting chart because it shows different market changes. And let's take a look here. Let's say, for example, we've seen several large declines, since 1987. Black Monday, we saw a drop of 33% in a 4-month period of time in the S&P 500. And the tech bubble, that we saw a decline of almost 50% over a 2.5-year period of time. But it also shows that 12 months later, the S&P 500 has moved on to a better place. Black Monday, 21% gain. After the tech bubble, a 34% gain. Now, COVID caused the S&P 500 to drop by almost 34% in less than a month. And as I mentioned earlier, we're slightly ahead for the year. Now, the best trading days usually follow the worst trading days. And while past performance is not an indicator of future performance, this information confirms that panicking and selling after a decline may not be the best investment strategy. So let's start talking a little bit about ideas and strategies for you heading into the end of the year. How should an investor move forward? One of our responsibilities is to look at all situations and guide our clients with ideas. A main goal for us is to consistently search for opportunities. Let's quickly review some of them. The first thing we'd like you to do is review your risk tolerance. Has it shifted at all after this year's volatility? Maybe what you could stomach a few years ago has changed and you realize that you're more conservative than you were previously. We also want you to review your time horizons. It's important to know your time horizon so you can be invested in the most appropriate portfolio. We look at your money almost in terms of buckets. We have the short-term bucket, kind of what you might be needing the next few years, a medium-term, and a long-term. And if you're a retiree, your portfolio is going to look very different than that of a 30-year-old. That's because the time frame of when you'll need your money is sooner. It's important to know what your time horizon is and if it's changed so your money can be invested in a way that best meets your needs. And maintaining a properly designed and well-diversified portfolio is important. We do this by rebalancing your portfolio. Rebalancing is defined as the process of buying and selling certain positions to bring your portfolio back into its original allocation. For our personal clients, we review our models and strategies on a quarterly basis, sooner if market conditions dictate. This year, we rebalanced in January to take some profits off the table and bring your investments back into tolerance because 2019 saw a nice run up in the market. We also rebalanced in March when the markets were down and took advantage of lower stock prices, as well as concentrating our fixed income positions more into federal bond holdings. And in September, we swapped out a fund that wasn't performing as well as we expected for something that was similar and was performing better. Now, earlier this year, the CARES Act created a new charitable deduction available in 2020 to all taxpayers, even if you don't itemize deductions. This new benefit is known as the universal deduction, and it allows for an above-the-line deduction for up to $300 per individual or $600 for couples who are married filing jointly. Now, to qualify for the charitable deduction, the gift that you give must be made in cash and be made to a qualified charity, and the contribution needs to be done by the end of this year. This deduction can be taken before you calculate your adjusted gross income. So the deduction acts like a tax credit, which is a dollar-for-dollar reduction in your income. And if you do take advantage of this deduction, make sure to let your tax preparer know that you did. And there are very strategic ways and places to be invested based on your tax bracket. This is why we review tax returns for our personal clients. If you're in these upper brackets, so the 37, 35% range, then I want to have you invested in tax-free investments, such as Roth IRAs, life insurance, and have investments that have tax-exempt interest, and that's municipal bond interest. And if you are in the middle brackets, kind of in the 22 to 24% range, I want to make sure that you're investing in IRAs, 401ks, 403bs. These are investments where you can defer your income. And if you're in a lower tax bracket, I want taxable income, capital gains, and qualified dividends. Capital gains and qualified dividends get taxed at 0% in these lower tax brackets. So we work to set up investments specific to your tax situation. And at the end of the year, you should go through a financial planning summary checklist, somewhat like this one. You want to understand, what's my tax bracket? What should I be invested in? What type of accounts? For itemized deduction timing, can I look to itemize this year? Maybe I should bunch some of my charitable deductions this year, take them, itemize, taking advantage of the higher deduction, and then maybe not do it for a few years. Retirement planning contributions. Did I max out my retirement plan contributions? If I didn't, did I contribute at least a minimum of my company's match? For education planning, did I fund a 529 plan for my kids or my grandkids this year? For capital gain, capital loss harvesting, do I want to take advantage or push back losses this year? Same thoughts around gains this year. And charitable gifting planning. Again, similar to what I talked about earlier with the deductions for itemized deductions, you want to think about, do I want to bundle some of those so I can take advantage of being able to itemize? We also want to look at estate tax planning. I don't know if you know this, but you can directly pay tuition or medical expenses for someone that you love, pay to the college or to the medical facility, and it doesn't count towards your annual gift exclusion. Then you also understand, are there any significant financial events that happened this year or maybe are happening next year? And what about life-changing events? Are you getting married? Maybe you're moving. Those are all things that you want to take into consideration and take a look at and review at the end of the year. Now, you should have received a copy of our third quarter economic update newsletter. We'll be back in November to review how the election results may have impacted financial planning strategies. If you know anyone who would benefit from our report, please pass it on. And if you know anyone who would benefit from watching this webinar or the one upcoming in November, please let us know. 2020 has been an unprecedented year. We're here to help make sense of it, and we appreciate the opportunity to assist you with your financial needs. And please call our offices whenever you need to.
Thanks, Jeannie, for all that insightful information. As she mentioned, if you have any questions regarding the current financial landscape or your specific financial situation, please contact us. And we will be back in touch following the election results with additional comments and insights. Thank you, and stay safe.